Big tech CapEx is surging. History says that rising CapEx does not always create value and often leads to share price underperformance. The biggest shift that an investor needs to recognize is that big tech is no longer asset light and high return. For example, Microsoft's CapEx to sales ratio is higher than ExxonMobil's. This is a sign that when companies move from scaling code to building physical infrastructure, risks rise that incremental returns will weaken. This is where the data becomes uncomfortable. Verdet Capital recently published a study that looks back nearly 3 decades that show that companies with higher capital spending did not deliver better returns. In fact, the strongest performers consistently came from businesses that generated high free cash flow while keeping CapEx low. Spending creates value only when returns exceed the cost of capital, and history shows that that's much harder to sustain at scale. What does this mean for you? The real risk for investors isn't that AI fails. AI could be a massive success, but big tech could still disappoint because the returns on the current CapEx will be below what they've enjoyed historically. The risk is also passively investing more of your dollars every month into a smaller number of expensive companies that may be at the cusp of struggling to maintain high returns. Be more selective and be aware of diminishing diversification within US equity indices. That's what we do at CSF. We evaluate the broad mosaic of information to adjust client portfolios to protect long-term performance so that clients can achieve their goals. I've written a more detailed research note with additional data and charts. The link is below if you'd like to dig further. We would be happy to speak to you personally, and you can contact us via the details on this page. We would love to hear your feedback on this content. Please read our disclaimer, and my colleague Alyssa will have some questions on this content.
Yeah, thanks, Aussie. So one thing that comes to mind off the bat is, have you seen similar episodes of rising CapEx in the past or in other classes? And what were the outcomes?
I would say yes. Throughout history, we have seen nothing identical, but in the late 2000s, you had a massive capex boom in the energy and material space, and those companies really struggled over the following almost decade-long period. We could probably look at the dot-com bubble and say it was too brief, but companies were given lots of easy money, which led to them spending. And you can look at the copper and the fiber optics that went into the ground, where many of the companies went under, but we now benefit from very cheap and widespread, high-speed broadband. So the historical analog is not good whenever we've seen a very high jump in
Hmm.
capex.
Yeah, interesting. Do you, obviously this would be kind of a question you probably don't know the answer to, but if you may have some thoughts about it. Do you think that there's any potential for uh, the way that um, companies are selected to be part of the S&P 500, like that might change? You know, I guess you can kind of take that from there.
Yeah, I mean, no, there's a committee that selects the S&P 500, but what happens is because it's market cap weighted, if you put in $100 every month, as the large get larger on this slide, the top 10 companies are now close to, this is the top Mag 7, but the top 10 are over 40%. That is a extreme level of concentration, and it really diminishes the diversification of having exposure to the overall
Mm,
economy, and now it's become very tech heavy.
yeah,
So that risk is quite apparent now.
yeah, yeah. I see. It's kind of more on the investor to kind of evaluate what they mean or what they're intending in terms of diversification. This idea of passive investing, as you mentioned, that might just be put on the investor to reevaluate what they're
Yeah. I mean,
doing.
passive will just mechanically send more and more dollars into the largest
Mm,
companies. But, until that changes for whatever reason, over a very long period of history, you've seen the S&P equal weighted index has outperformed substantially. But there are these 5 to 10 year periods where it can underperform, and the cap weighted, the S&P that we know,
mm, mm.
outperforms.
Yeah.
And we're at one of those periods. We just don't know if it's, halfway there or, nearly
Mm.
there at the end of it.
Yeah, it's like kind of like people that invest in the um what did you call it? The when it's percentage based
So it's market cap, or it's called cap
cap
weighted,
weight.
which is the regular S&P. And an equal weighted will be all 500 companies have a equal weight. So obviously it significantly underweights the tech sector, these
Mm.
large, Mag 7 or the top 50 to 100 companies
Yeah.
that are of outsized weight at the
Yeah.
moment.
It's interesting to think about um from this perspective of like there are some investors that will intentionally weight their portfolio toward a growth, like a large cap growth versus a
Mhm.
large cap value or something like that. It's almost like if you just invest in the market weighted version, you're kind of unintentionally investing in the large cap growth uh, category.
Yeah, I mean, I think a professional would know that you're significantly overweight growth in the regular S&P 500, but I bet there are many who do not realize
Yeah.
that and think this provides the same diversification it provided, in the past few
Hmm.
decades or,
Yeah.
historically.
Interesting. All right. Well, thanks, Aussie.
All right. Thank you.